Welcome back to the channel, investors. Today, we're diving deep into a fascinating move by CapitaLand India Trust that could reshape its future, their 100 million Singapore dollars perpetual securities issuance. This isn't just another bond, it's a strategic capital play amidst India's booming economy and a dynamic interest rate environment. Let's break it down. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. First, for those unfamiliar, CLINT is a Singapore-listed business trust that focuses on owning income-producing real estate in India, primarily business spaces. Think IT parks, logistics facilities, industrial sites, and increasingly data centers. As of December 31st, 2024, CLINT manages a diversified portfolio valued at 3.7 billion Singapore dollars with properties across key Indian cities like Bangalore, Chennai, and Mumbai. They also have significant land for future development, signaling strong growth ambitions. Financially, CLINT has shown robust performance. For the second half of fiscal year 2024, total property income increased by 15% to 141.8 million Singapore dollars, and net property income rose 12% to 102.1 million Singapore dollars. Their distribution per unit grew 3% for 2H FY 2024, contributing to a 6% year-on-year DPU growth for the full FY 2024. However, it's crucial to note CLINT's dual currency approach. Their earnings are in Indian rupee, but reporting and distributions are in Singapore dollars. This introduces foreign exchange exposure, where a weakening INR can dilute strong INR performance when converted to SGD, impacting reported DPU and NAV. Now let's talk about the big announcement. CLINT successfully priced 100 million Singapore dollars in 4.4% subordinated perpetual securities on June 25, 2025. These are part of CLINT's larger 1.5 billion Singapore dollars multi-currency debt issuance program. They are expected to be listed on the Singapore Exchange Securities Trading Limited around July 3, 2025. Why did CLINT choose perpetual securities? The strategic intent is multifaceted. The net proceeds are earmarked for refinancing existing borrowings and repaying outstanding loans. This is about optimizing their balance sheet and reducing refinancing risk, financing ongoing business activities, funding future acquisitions. This aligns with their goal of expanding into high-growth sectors like IT, logistics, and data centers in India, bolstering general working capital. Crucially, perpetual securities offer equity-like treatment on the balance sheet. This means CLINT gets a permanent source of capital without diluting an existing unitholder ownership. It's a smart way to strengthen their capital structure and manage key financial ratios like gearing. This move underscores CLINT's confidence in India's long-term growth prospects and its desire to maintain financial agility. For those new to the concept, what exactly are perpetual securities? Unlike conventional bonds, perpetual bonds have no maturity date. The issuer isn't obligated to repay the principal amount. Instead, they promise a continuous stream of interest payments, theoretically in perpetuity. Think of historical consols from the 19th century. For issuers like CLINT, they are a permanent source of capital, providing long-term funding without periodic principal refinancing. Modern perpetual bonds, including CLINT's, typically include call provisions. This grants the issuer the right to redeem the bond at predetermined dates, often 5 to 10 years from issuance. This flexibility allows issuers to refinance if interest rates become more favorable, turning the perpetual aspect into a strategic choice. However, investors face risks. No fixed maturity date means no guaranteed principal return unless called. They typically offer higher interest rates to compensate for this. Creditworthiness is key. Deterioration can lead to non-payment. Interest rates and inflation risk can diminish market value and purchasing power. Call risk means investors might have to reinvest at lower yields if rates drop. Most, like CLINTs, are subordinated, ranking lower than senior debt in liquidation. A critical feature is non-cumulative deferral, where the issuer can choose not to pay distributions without triggering a default, and these deferred payments do not accrue interest. Let's look at the specifics for CLINT's perpetuals. Principal amounts 100 million Singapore dollars. Classification: subordinated perpetual securities. Issue price: 100% of the principal amount in denominations of 250,000 Singapore dollars. Initial coupon rate 4.4% per annum, fixed from July 2, 2025 until the first reset date on July 2, 2030. Reset rate every 5 years. The rate resets to a fixed rate equivalent to the 5-year Singapore overnight rate average overnight index swap plus an initial spread of 2.655%. Call option: CLINT can redeem all securities on the first reset date, July 2, 2030, or any subsequent distribution payment date at par plus accrued distribution with 30 to 60 days notice. Non-cumulative deferral: CLINT has the sole discretion to defer distributions, fully or partially, without default, and deferred amounts do not accrue interest. Dividend stopper: if distributions are not paid in full, CLINT is restricted from declaring dividends or distributions on its junior or parity obligations. How does this impact CLINT's financial health? As of March 31, 2025, CLINT's gearing ratio increased to 41.5%. Management expects this to decrease below 40% once proceeds from planned divestments are realized. Issuing 100 million Singapore dollars in subordinated perpetuals would typically help manage this ratio and provide additional headroom within its debt covenants. Their interest coverage ratio, ICR, was 2.7x in 1H24. Their cost of debt remained stable at 6% as of March 31, 2025, with 84.5% of debt fixed, mitigating immediate interest rate volatility. Regarding its credit rating, Fitch Ratings affirmed CLINT's BBB- rating. However, on March 10, 2025, Fitch revised its outlook on CLINT from stable to negative. While perpetuals are often treated as equity-like by rating agencies, boosting the capital structure and providing a buffer for senior creditors, this issuance alone may not fully alleviate the broader credit concerns that led to Fitch's negative outlook. These concerns could stem from factors like higher financing costs or the ongoing impact of Indian rupee depreciation on SGD-reported financials. CLINT's timing is strategic. The Singapore dollar credit market showed robust performance in 1H 2024, with issuance volume surging 75% year-on-year to 15.6 billion Singapore dollars. This was driven by healthy investor appetite, declining yields, and tightening credit spreads. Despite a higher for longer interest rate outlook from the U.S. Federal Reserve, Singapore government securities yields have mirrored U.S. Treasuries, and SGD corporate bond spreads have tightened. The real estate sector, especially Singapore REITs, significantly increased bond issuance for refinancing and locking in funding costs. CLINT's 4.4% coupon rate is competitive within the Singapore REIT perpetual market. Here's how it compares to recent issuances. ESREIT, March 2025, 125 million Singapore dollars at 5.75%. CapitaLand India Trust, May 2025, 260 million Singapore dollars at 4.2%. Suntec REIT, June 2025, 250 million Singapore dollars, fixed rate, specific coupon not detailed. CLINT's 4.4% rate places it strategically, indicating it found an optimal pricing point reflecting its credit profile and market demand. This timing suggests management is adept at capitalizing on robust demand and tightened spreads to secure flexible long-term funding, crucial for a trust with significant development and acquisition plans in India. So how did the market react? The initial response to CLINT's perpetual securities pricing has been characterized by stability. On July 2, 2025, CLINT's unit price closed flat at 1 Singapore dollar and 6 cents, with no significant price volatility in the past 3 months. This points to a generally positive reception from institutional investors who are the primary subscribers. Analyst coverage remains largely positive. The consensus share price target is $1.24, implying a potential upside of approximately 21% from current levels. DBS Research and OCBC Investment both maintain buy ratings with target prices of $1.45 and $1.23, respectively. The overall analyst consensus is a moderate buy. Independent valuations even assess CLINT's units as undervalued, trading at 17.9% below estimated fair value. The successful issuance and imminent listing underscore positive institutional investor reception. The market seems to view this as a sound financial strategy rather than a cause for concern, focusing on CLINT's underlying asset quality and the compelling growth narrative in India. Looking ahead, CLINT is strategically positioned to capitalize on India's robust economic expansion. The IMF projects India's growth at 6.5% for 2024 with upward revisions. CLINT's operational strategy aligns with these tailwinds, focusing on the fast-growing IT, industrial, logistics, and data center sectors. They continue to pursue aggressive growth through acquisitions and land development. Analysts forecast an impressive 8% compound annual growth rate for CLINT's DPU over the next 3 years. For investors, existing unit holders, this issuance is positive, providing long-term, flexible capital without equity dilution, supporting growth and stabilizing future distributions. Perpetual security holders, these instruments offer a competitive fixed income stream, 4.4% initial coupon. However, remember the subordinated ranking, non-cumulative deferral, and call option risks. In summary, CLINT's Perpetual Securities issuance is a calculated move. Strategic benefits, diversified funding, broadened sources beyond traditional debt. Capital structure optimization, equity, like capital, improves gearing without dilution. Growth enablement funds acquisitions in high-growth Indian sectors. Financial flexibility, callable nature allows dynamic cost of capital management. Potential challenges: foreign exchange risk, INR depreciation impacts SGD reported financials. Macroeconomic sensitivity, India's economy can shift. Interest rate environment, reset mechanism introduces variability after initial fixed period. Perpetual specific risks, no fixed principal repayments, subordination, non-cumulative distributions. This strategic move positions CLINT to continue its expansion in India, balancing financial prudence with ambitious growth targets in a dynamic and high-potential market. It's a testament to their proactive capital management strategy. What are your thoughts on this? Let us know in the comments below. Don't forget to like this video, subscribe for more insights, and hit that notification bell so you don't miss our next update. Thanks for watching, and we'll see you next time.